This is a CEO Radio podcast conversation. I'm Ray Hoffman. Among the many role players in the global economic crash of 2008, the big three Wall Street credit rating firms had more than a supporting part, because neither Moody's, nor Standard & Poor's, nor Fitch caught the red flags that started going up around housing and mortgage finance, beginning in some places as early as 2005. So after things settled a bit in 2010, the famed and highly respected corporate investigator Jules Kroll started his own firm. And today it's by far the biggest of the 40-some credit rating firms that were started around the world after the meltdown. Here's the first part of my CEO Radio conversation with the man Jules Kroll hired to build and run the Kroll Bond Rating Agency, CEO Jim Nadler. In, say, 2006, if a firm, an issuer of debt, wanted to have Moody's or Fitch or Standard & Poor's rate that credit instrument, how did they pay and what did they get?
I think what they got was a very substandard product. I think they got a cursory review, and I think that they got a short analysis of the company that was relatively superficial.
And they didn't have to pay for what they didn't take, right?
Depends on the type of issue, but yes, that's true.
So they could shop around. Somebody that had a portfolio of the things we've heard about in the past could shop around for a decent rating from the three companies that dominated the industry for so long.
Right. I think that's true. And I think I think back then things weren't as transparent. I think a lot of their models were opaque. And I think that, which was one of the things that led to the crisis. And so I do think that there was a lot of questioning from investors about what actually was going into the models and what the output was. And I think that led to a feeling that maybe we don't know everything and maybe we're not getting the full story.
And there was that feeling even in 06 and 07 before the crash, right?
Yeah, I think so. If you go back to the early 2000s, you had Enron, you had Global Crossing, and so there was already this issue in corporates. How were the rating agencies missing these red flags? I mean, Enron, people were writing about it. There were people questioning their numbers, and you could have looked and seen that they had very little cash on the balance sheet, yet they were making $1 billion a year. So it was clearly all in accruals. So they already had that crisis. And then you get to the structured finance, the subprime crisis. And it was the same issue again. It was, are they missing something? Are there red flags? And there were red flags. There were these early payment defaults that they were missing. And so there was a sense that the big rating agencies were simply in it for the money. They had forgotten who their client was, the investor, and they were no longer paying attention to what the investor's needs and wants. By the time of the crisis, if you remember, it was after the Wall Street sell side had really sort of been gutted by the rules with, the Elliott Spitzer's investigations. And so Sell Street research was really going away, and there was very little of it. And so in a lot of these cases, it was really left to the rating agencies as the sort of the front line, and the ones that were really the ones that were one of the few people that were in a position to see what was happening as it unfolded. Now, certainly the investment banks that were doing the deals were in a position, but the rating agencies were in a position, and it was their job.
And then comes 2008 and the early months of 2009, and Jules Kroll comes into the business and sets up a different model.
Exactly. So Jules had this notion, and it's really interesting because Jules had no experience in credit ratings other than he had been a consumer of credit ratings. And he thought to himself, there's got to be a better way. These guys, when he had his company, Kroll, the Corporate Investigation Service, he said he would, they would come in to rate him. They'd spend a day, send him back a very thin description of his company and charge him a lot of money. And so after the crisis, Jules said, there's got to be a better way. And so he decided that he was going to set up a company that was going to do things differently. And that's what we have. That's what we were set up to do. And I think that's what we've been able to do in the last 8 years.
How important in the overall scheme of things was it to have maybe the best corporate investigator there ever was, maybe the best private eye there ever was, even including Sam Spade in the movies, establishing a new bond rating firm after the meltdown?
I think it was important because it became part of our DNA. It became part of the way that we saw the world. And I think that the ability to think about things in the same way that investors thought about things, and ask more questions, be more inquisitive, spend more time looking under the hood with management, and then be able to convey that information to your real client, which is the investors. I think his career and everything Jules stood for became part of who we are and continues to be part of who we are.
And you were on the investor side when the firm started. What did you observe?
Well, I actually was on the investor side just prior to it starting, and I actually got here just as it started. But being on the investor side, I saw the same things Jules did. I saw the subprime meltdown. I saw the incumbent rating agencies' inability to not only see the crisis as it happened, but in the aftermath of the crisis, the incumbent rating agencies made an even bigger mess of it. They couldn't keep track of all the deals they had rated. They would downgrade wholesale groups of bonds when some of them should have been downgraded and some of them shouldn't have been downgraded. And so it was really the aftermath too that I think the incumbent rating agencies really let the investing public down. And so I was on the buy side during all of that and saw that. And so when I first met Jules, I was 100% in and said, look, you're absolutely right. There is a better way. And I think together we can do this. We can make this industry better.
And that includes a better pay model for credit ratings.
Well, I think that we're more transparent. We have the same pay model that Moody's and S&P do. We all get paid by the issuers, and I can explain why that's important. But I think that we're more transparent about the work that we do, and we're more transparent in the product that we release. So when we write about a credit, we write about it thoroughly. We'll give you, a lot of times we'll give you 25 pages on a credit when our competitors will give you 5. And that's important because then investors can have the tools that they need to either agree or disagree with our opinion. And that's what we want. We want this dialogue with our clients, the investing public. It's important that rating agencies be paid for by the issuers, even though there are conflicts, and you have to be open about those conflicts. You have to be transparent about how you ameliorate those conflicts. But it is the way that ratings are available to everyone. If investors paid for ratings, if I'm investor A and I pay for a rating, I'm not going to share it with anybody. Why do I want to have free riders? So you actually contribute to the asymmetry of information in the market. Rating agencies are all about getting rid of that asymmetry of information. And so, although the model does have conflicts, and it's important that we're upfront about how we ameliorate them, it is the best model for investors in the long run.
Can an operation that may be a little less than forthcoming about everything in its operation still shop around in this day and age?
They can. But it has become increasingly harder because the Dodd-Frank Act and the Credit Rating Act of 2006 require that rating agencies publish their methodologies, and they publish their methodologies thoroughly so that investors know exactly how they're looking at bonds. And then it's important that you stick to those methodologies when you rate the bonds. It's had an unfortunate side effect, unintended consequence for our competitors. And what it's done to the incumbent rating agencies is it's caused them to do less work. And it's caused them to say, okay, We're going to tell our clients we do ABC. That's all we're going to do. And then if we're wrong, at least we told them what we did. And where we have taken a completely different tact, and that is that it's even more important now that investors have the information they need. So we spend more time with management. We spend more time in conveying that information to our clients. And that's, I think, in a nutshell, why we've been so successful.
And tell me about the early days of the firm.
The early days were harrowing. Rating agencies are unlike many other companies that you start, because there's a whole bunch of development work that has to be done before you ever start talking to clients and ask for ratings and then get paid. You have to develop all of your methodologies. You have to go out and visit investors and let them meet your analysts. Make sure they're comfortable with your analysts. Have dialogues with your client. So I think our first revenues were 1 year after we started, and there weren't very many of them. Startups are fun. They're scary, and we certainly had our share of scares, and we had our share of fun. But we realized, I would say by 2012, that we were onto something. The connection that we were making with investors was starting to really take hold. And it was clear to everyone in the firm at that point that we had made this connection and that we needed to continue to develop this connection with investors. And they were actually telling us what they wanted to see. In some of the areas, we would talk to them about, well, what do you need to see to do your work? And they would tell us, well, you need to do more here. You need to look at this. And so it became a really nice symbiotic relationship where we were giving them more and they were telling us more and more refined things that they wanted. And again, I think it's why today we are so close to many of our investors, even though they have been clients of Moody's and S&P for, in some cases, 50 years.
And your investors, did they expect a different kind of employee when you started the firm?
I think they did. I think the traditional rating agency blinders on. I'll give you one example. When I was on the buy side, it was in the midst of the crisis, and I called up one of the incumbent rating agencies. I won't tell you which one because it's not a great story. And I said, you downgraded this bond. You see it's trading at 80 cents on the dollar. You downgraded it to single B. You're wrong. And she said, and I quote, "We don't follow the market." And so after the crisis, nobody wanted to hear that anymore. And so we hired people who had all different backgrounds, some buy side, some sell side. Some had been strictly research analysts. And that mix of people continues today to be one of the great pillars of our company, because when we have a credit committee on a credit, we have people from all different backgrounds giving their opinion, and it makes our work so much better. And the investing public was expecting that after the crisis.
And I assume with the Kroll name on the door, many people must have come from the investigations world in one way or another.
We did have people that came from the investigations world, and it was interesting because one of the other ththings that was very interesting when we started out, we had a lot of good people that had really solid names in the market. And so we first went out to investors. We had a lot of recognizable names. But there were many times we'd go to an investor and they'd say, "Oh, I used to use Kroll when I would investigate people that we were hiring, and so I know your boss. He's a great guy." And so the Kroll name really did mean something in the fixed income market when we first started, and so we certainly benefited from having that name on the front door.
Even though he had nothing to do ever in his life with the fixed income market. Even though he
had never been part. Yeah, exactly.
Now, how many employees were there at the very beginning?
At the very beginning, we had maybe 10, and today we have 320, and that's in 4 offices. We have an office in Pennsylvania, where we do a lot of our technology work. We have a product that we have in the structured finance market out of there. We have an office in Maryland where we do most of our financial institution work. We just opened an office in Dublin, and then we have our flagship office in New York City.
And tell me about the growth internationally. Dublin is obviously the center for that.
Dublin is the center for it. So we were approved by the European Union in November. We started doing deals in second quarter of this year, and our revenues from Europe should top a couple $1 million this year, and we expect that to quadruple next year. So there's a vibrant market in Europe that again is looking for a new voice, and we aim to fill that.
There's a part 2 to this conversation with Jim Nadler, CEO of the Kroll Bond Rating Agency, and it'll be posted right here at radio.com. I'm Ray Hoffman.